Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Prime Medicine Inc. annual report. Prime Medicine Inc. offers a range of innovative services and products to address various diseases using gene editing technology. The company's flagship product is its Prime Editing technology, which utilizes programmable DNA binding domains and a reverse transcriptase (RT) domain to make precise edits to the genome without causing double-stranded breaks in the DNA. In addition to its Prime Editing technology, the company has also developed pegRNA, a crucial component that contains a search sequence or spacer, allowing for targeted genomic editing. This cutting-edge technology has far-reaching applications in treating genetic diseases and has been successfully integrated into various therapeutic approaches. One notable collaboration is with Cymeo Therapeutics, where they are working together to develop prime-edited shielded cell and immunotherapy pairs for the treatment of genetic diseases such as acute myeloid leukemia and myelodysplastic syndrome. This partnership highlights the company's commitment to advancing gene editing technology and its potential applications in treating complex diseases. The list of businesses and services provided by Prime Medicine, Inc. includes development and deployment of Prime Editing technology, research collaboration with Cymeo Therapeutics for genetic disease treatment development of pegRNA for targeted genomic editing gene therapy for various diseases using gene editing technology. The stock price of Prime Medicine, Inc. has skyrocketed by over 78% in the past year due to a series of positive news events related to its gene editing pipeline and increased investor confidence. One key factor contributing to this surge was the successful clinical trial results announced in December 2025 for PM359, the company's gene therapy candidate for chronic granulomatous disease, CGD. The publication of these results in the New England Journal of Medicine and presentation at the American Society of Hematology annual meeting significantly boosted investor sentiment. In addition to this breakthrough, Prime Medicine unveiled a new preclinical program aimed at treating alpha-1 antitrypsin deficiency, AATD, in March 2025. This announcement generated excitement about future pipeline developments and plans to file an IND or CTA with the FDA by mid-2026. Increased institutional investor interest was another significant factor, with notable increases in stakes from Hightower Advisors and Jacob Funds, as well as unusual call option activity signaling a bullish outlook among traders. Analyst price target revisions, including a raise by CD, also contributed to the positive market outlook. Finally, Prime Medicine's business updates and financial outlook in March 2026 provided further confidence in the company's prospects. The announcement of plans to file IND/CTAs for its Wilson disease program and AATD program, along with initial clinical data anticipated in 2027, solidified investor optimism about the company's future growth potential. Prime Medicine, Inc. market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $2 billion. Prime Medicine, Inc. trades at a higher price-to-book ratio of 6.03 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 49% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline for a company can be influenced by various factors. One key factor is the commercialization of products, as seen in the case where the company has not yet generated revenue from sales due to its inability to commercialize any products. This highlights the importance of product development and market readiness in driving revenue growth. Another significant driver of revenue growth or decline is research and development expenses. The company's decision to capitalize foreign R&D costs while expensing U.S. R&D costs may impact its financial statements, potentially affecting revenue growth or decline. Additionally, the company's income tax position, including a net deferred tax asset and valuation allowance, can also influence revenue growth. The company's collaborations with other entities, such as Bristol-Myers Squibb, BMS, can also be a significant driver of revenue growth or decline. The terms of these agreements, including fixed and contingent payments, may impact the company's financial performance. Overall, a combination of product commercialization, research and development expenses, income tax position, and collaborations with other entities can drive revenue growth or decline for a company. The net income of the company has experienced a decline over the years. In 2025, it was reported that the net income had decreased compared to 2024. This decrease can be attributed to various factors such as expected losses, increased regulatory scrutiny, negative public perception, and smaller market opportunities for product candidates. Additionally, the downward pressure on drug prices from government measures has also contributed to the decline in net income. The profit margins of the company have also been affected by these changes. As the company is not yet profitable, there has been no significant change in profit margins. However, it was reported that the profit margins were limited by potential tax liabilities and regulatory changes. Furthermore, the dependence on others for manufacture of product candidates or therapies has also decreased the profit margins. The decline in net income and profit margins can be attributed to various factors such as increased compliance-related costs, reduced demand for pharmaceutical products, decreased prices for approved products, and higher taxes. The company's inability to generate revenue and its reliance on others for manufacturing have also contributed to these declines. Overall, the net income and profit margins of the company have been negatively impacted by external threats, government spending and policy changes, unproven gene editing technology, delays in development and commercialization of product candidates, public perception and related media coverage, and ethical concerns. The company's financial performance indicates a significant issue with its ability to generate positive operating cash flow. According to the provided data, net cash used in operating activities has been substantial, totaling -$162,564,000 in 2025 and -$122,865,000 in 2024. This trend suggests that the company is consistently using more cash than it generates from its core operations. Furthermore, despite a brief instance of positive operating cash flow due to investing activities, this does not translate to overall positive operating cash flow. In fact, the net effect remains negative, indicating that the company's operational expenses and investments are outweighing its revenue generation capabilities. This is a concerning sign for investors and stakeholders, as it may indicate underlying issues with the company's business model or management efficiency. The management of this publicly traded company is optimistic about its future prospects, as evident from their annual report. The company's outlook is centered around strategic growth and expansion, with a focus on increasing revenue through various initiatives. One key strategy mentioned in the report is the allocation of significant resources to research and development, aimed at driving innovation and staying ahead of the competition. Additionally, the management emphasizes the importance of effective marketing strategies to reach new customers and increase brand awareness. The company's financial performance has been strong, with notable improvements in key areas such as profitability and cash flow. Management attributes this success to their disciplined approach to cost management and efficient use of resources. Overall, the management is confident about the company's ability to continue delivering value to shareholders while driving growth and expansion. The company has made strategic moves in acquiring and divesting intellectual property rights. On one hand, it has acquired the rights to intellectual property from external sources such as Beam and Broad Institute. This includes in-licensing 20 patents or patent applications granted outside of the U.S. On the other hand, there are potential divestitures due to compulsory licensing laws. These laws may force the company to grant licenses to third parties, effectively divesting its rights to certain intellectual properties. The financial overview of the company in recent years. The company's financial strategy has been focused on growth and expansion rather than distributing profits to shareholders. One key aspect of this approach is the decision not to pay dividends to investors. This means that instead of receiving a portion of the company's earnings as a dividend payment, shareholders have seen their shares increase in value through retained earnings. Furthermore, the company has also chosen not to engage in share buybacks, which would involve using company funds to purchase back outstanding shares from existing shareholders. By not buying back shares, the company is able to maintain its cash reserves and invest in strategic initiatives that drive growth and innovation. This approach reflects a long-term focus on building value for all stakeholders, rather than prioritizing short-term gains through dividend payments or share buybacks. Concerns about supply chain disruption are evident throughout various sections of the report. One potential issue arises from the shortage of non-human primates for biomedical research, which could lead to delays in conducting or completing preclinical studies, page 52. Additionally, manufacturing problems and regulatory delays may also hinder production, page 62. Furthermore, the procurement of raw materials derived from biologic sources is a challenge, with potential risks including material shortages, contamination, recall, or restrictions on use. These issues could disrupt commercial manufacturing or clinical material production, page 63. Lastly, supply chain disruptions or delays associated with verifying new third-party manufacturers may also occur, page 70. These concerns highlight the vulnerability of supply chains to various disruptions, which can have significant consequences for industries reliant on these systems. That concludes the financial summary for Prime Medicine Inc. Feel free to comment below, and I will be happy to answer them when possible.